maybe to mention a few, cash flow for the advanced cash flow in this section here is covering a situation whereby a subsidiary has been acquired or a subsidiary has been acquired. A subsidiary has been disposed. Either of those two or both, they can combine them in a question. They have ever done that before. So any cash flow in this level, you will get a cash flow where a subsidiary was acquired or a subsidiary was disposed. For example, check for me that setting. Just a cross check. I think it was question 2. Just go to the additional information, mostly additional information number 1 or 2. You will be able to see a subsidiary disposed or subsidiary acquired. What did they talk about? Disposed of, yes, disposed of. So last sitting, they captured disposal. So that is not a sure bet that now it is going to be acquisition. We'll just have to. So that is what makes it different with the cash flow in section 3. Here, you check for disposal or acquisition of a subsidiary as the year progresses. Not at the start, not at the end. You will find it was acquired or disposed within the year. So how do you incorporate it in what? Cash flow. That is 1. 2, when you are coming up with your formats, you realize we have how many methods? 2. We have indirect and the direct methods. So mostly, as we progress, you will realize that you will develop interest for indirect method. It is easier to apply than direct method. But at this level, those people normally dictate or which method to use. Sometimes they will tell you indirect, sometimes they will tell you direct method. So usiseme ati wewe ni mtu wa direct ama wewe ni mtu wa indirect. Kwa hiyo swali hebu angalia required, if they dictated, just required. Unasoma mpaka mwisho. Cash flow, what? Using indirect. So last sitting as well, they dictated the method they wanted us to use. So sometimes the question is open. You choose whichever method you want. Sometimes they do dictate. There are some you'll see them saying using direct method. So you must know how to apply both direct and indirect. You must know how to apply all of them, and also know that the cash flow here is either acquisition of a subsidiary or disposal. That is 1. Now those are 2 critical issues which you're supposed to know in the advanced cash flow. There is either acquisition or disposal. Then methods are normally dictated in most instances, the method to use. So you must be acquainted with all the methods. Something else, now maybe the normal, when working out the operating activities, most of for indirect method. So under operations, no, those ones are going to explain why doing a question. Allow me to bump into a question immediately. So the format will just go with the question. So in fact, what are to find here last sitting? Let's try out the one for last sitting. The last sitting, you have seen question 2. So go to April 2022. April 2022. Question 2. April 2022, question 2. So you are there. So let's read. If you can finish that, can be a plus. So actually tukimaliza hiyo tutakuwa tumefikia watu hivi. So it can be very nice for us, I think, yes. We have done one question on cash flow. Question 2, it says, the following draft group financial statements relates to H Limited, public limited company, and its investment companies. Required meaning group statement of cash flow. So tuandike hiyo heading. Usome tutapata hapo mbele, ndio? So right there, H group. So H group consolidated statement of what? Of cash flows. For the year ended when? For the year ended 31st October 2021. So how much? Shillings are in millions. Alright, so from your format, let's start with operating activities. Operating activities. Operating activities. Somebody can present for Amit, Josephine, the question in the group. Napiga picha. So there's something, when you want to take the photo. I take photo. Me. just sent. So let's continue reading. Let's go now to the financials. Let's go to the financials. Let's go to the financials. So to the financials, we have property, plant, and equipment. We have goodwill. We cannot read those things. The only issue I detected with non-current assets, nataka uniongeze. Okay, number one, there was a mistake. Unaona hapo wameandika they have written 2021. Which the balance sheet. They have written 2021. So that is not okay. This one was supposed to be 2020. See, customer whoever was compressing for us, I don't know what happened. So this one is 2020, just changed. That was one mistake. I rectified. Then, can you add non-current assets for 2020? No, not for 2020, for 2021. They have given us a total of 92.25. Can you add whether it is coming to that figure? Add whether it's coming to that figure. 91, eh? Yeah, there is a variation. So the mistake was on the other intangible assets. Other intangible assets, instead of 12, they wrote 1250. It was supposed to be 1350. So I'll adjust that one, 1350, not 1250. It's supposed to be 13. So that was a very small mistake, which cannot make us not do the question. I then group statement of profits or loss, another comprehensive, as you can see. Additional information. During the year ended this, H Limited disposed of, unlike the word disposed, that is now the main issue there, disposed of 80% equity holdings in S for 310 million in cash. The carrying amount of the identifiable net assets of S at the date of disposal were 300. They took all the assets, they subtracted liabilities. So the net assets on the date of disposal is 300. The net assets is represented by equity components, which is the assets minus what? Liabilities, sure. The gain/loss on disposal of the subsidiaries is included in administrative expenses. The disposal of S is not classified as a separate major line of business or geographical operation. The investment in S had been acquired several years ago at a consideration of 230, when the fair value of the identifiable net assets stood at 250. The group's policy is to measure the non-controlling interest in all subsidiaries at their proportionate share of net assets at their acquisition dates. An impairment test carried out on 31st of October 2021 showed that the goodwill, other than that arising on the acquisition of S, was impaired. Other intangible assets were also impaired. Number 4, H disposed of plants with a carrying amount of 440 for a cash proceeds of 560. The gain on disposal is included in administrative. The following schedule relates to the depreciation charge to profit or loss during the year was 260. The following schedule relates to the financial assets at fair value through other comprehensive. Balance at the start, carrying amount of the financial assets, purchases of financial assets, fair value gain of financial assets. The sales proceeds of financial assets were shillings 360 million. Profit on the sale of the financial assets is included in investment income in the financial statements. The profit for the year attributable to non-controlling interest amounted to 390. Required a consolidated statement of cash flow for the year. Nasoma yote, so that when they dictate the method, you can be able to see using the indirect method. So operating activities are those activities which we incur on daily operations, and they're just within the company. So we start with the profit, but not profit after tax. You know, when you say after tax, you are past operations. Operation is within the company. When you say after tax, it means you have gone to KRA, Melipa, and Merudi. So that is past operations. The reason why I'm very careful on that, some people are doing for Nasau committee, do I use profit after tax or before? It should be before you are still within the operations. Ukienda after, then you are past operations. So always, please, that is a tick which you must get. Profit before what? Tax. Can you check for it in the profit account? Check for it in the profit account. Yes? 1675. Then you say adjust for. So all adjustments. So what do we want to adjust? You know, for you to arrive at profit before tax, you started from revenue, which is maybe sales. You have subtracted all expenses. That is how you arrive at profit before what? Tax. There are expenses which you captured here, but they are not operating expenses. Operating expenses are those expenses which you incur on daily what? Operations. So any expense which you don't incur on the normal operations, you add them back. You see something like depreciation, you will add it back for two good reasons. One, it is not a cash expense. Hakuna pesa ilitoka. You know, cash flow is checking cash in, cash out. Depreciation, there is no money which left. That is one. Two, it is not an operating expense. We don't incur it on daily operations. So any cash flow, well, ukifika tu kwa cash flow, once you have brought the PBT, just come here straight, then you say what? Depreciation. It was given a certain note. Can you check which note it was given? The small note before note 5, in between 5 and 4. Again on, depreciation charge in the profit account was how much? 60. Add back. That is not an operating expense. Then depreciation has a very close sister. Close sister known as impairment. So once you have written depreciation, always capture impairment. And how will you know that there is impairment? Goodwill and intangible assets. So for example, check note number 3. Check note 3. They are saying that an impairment test carried out on this show that goodwill other than that arising on acquisition of S was impaired. Other intangible assets were also impaired. So we have two impairment clauses here. We have impairment on goodwill, and we have impairment on intangible assets. Those two. So they have not given us direct the figures, but I can show you how you will be getting it. This is how you will be getting those impairments. This is how you'll be getting those impairments. So I have an outside working. To get impairment, reconcile goodwill account. To get impairment, reconcile goodwill account. Reconcile goodwill account. So balance brought down. Balance brought down. Balance brought down. How much is the value of goodwill? Check non-current assets. Goodwill is appearing in non-current assets. How much is this? 1080 is the opening value of goodwill. Then there's a subsidiary we were having and it was sold. So when you sell, there is what we call an impaired goodwill, then what? Disposed. So you less goodwill in subsidiary disposed. Subsidiary left us. So what you do, check how much was the goodwill in this company. So check note number 1, but the last bit before note 2. The gain for here. The investment in S had been acquired several years ago at a consideration of how much? 230. So consideration of 230, when the fair value of the identifiable net assets was 250. The only problem we have, they are saying, the group's policy is to measure the non-controlling interest in all subsidiaries and their proportionate share of the net assets at acquisition. So net asset at acquisition as per that note is 250. So as per that note. So they have said consideration 230 when the fair value of identifiable net assets was 250. You know, it is full method, but they are not opening up well. But they are saying the value of NCI was the proportionate share of the net assets. So it means the fair value of minority is 20% because the parent had acquired 80. 20% of the net assets, which was 250 on the date of acquisition. So this is the investment by the parent. This is the fair value of NCI. Their proportionate share of the net assets. Then you subtract those net assets, which is 250. So that's how we get goodwill penalty. So yes, you take the purchase consideration plus the fair value of NCI. So NCI, they never gave the fair value, but they say the fair value of NCI is the proportionate share of the net assets at acquisition. So minus 250. How much? 30. So this one left. Meaning at the end of the year, we should be having how much? 1080 minus 30 should be 1050. It should be 1050. Skip one line. According to examiner, balance carried down. Balance carried down 945. That decrease is impairment. This one here. The decrease is impairment. How much? 105. That decrease. So goodwill went down by 105. That is the impairment which they are not telling us. Impairment loss. So it's simple. You check the opening value of goodwill. So then you check this subsidiary we were having. How much was the goodwill in it? Calculate that goodwill, subtract, then compare with the closing. The difference is impairment. So impairment of goodwill, go back to cash flow. That was 105. Even that one they are subtracted as an expense. You add back. So let's go to intangible assets. They said intangibles were also impaired, but there is no note talking of intangibles. So just go direct to the balance sheet where we have those intangibles, then compare the difference. We don't even need a working. So other intangibles, the opening was 1800. It went down to 1350. In case someone joined late, other intangibles we rectify, not 1250, it should be 1350. When you add those some, there's a difference of that. So it's just the decrease, 18 minus 1350. How much is that? 450. Add back. Let me close this door. Security purposes. Alright, so that is it. So I want you to master the flow. You start with profit before tax, bring depreciation and impairment. Can you check, is there an item of PPE or not PPE per se? Is there any item of non-current asset which was sold? If yes, was it sold at a profit or at what? A loss. Yeah, I saw some. Check note 4. Note 4 and 5. Note 4, hedge disposed of a plant with a carrying amount of 440. Okay. For how much? 560. They lost the gain. The gain was included in administrative. You know, gain on disposal, you will subtract. Gain on disposal is not an operating income. The only operating income we have is the daily what? Sales. So in the question, when they write revenue, we assume revenue is the sales. Any other income apart from that one is not an operating. Fine, we acknowledge it's an income, but it is not something we generate on our daily operations. So that gain, they are used to reduce admin. Bring it back. TOR. So you come and say gain on disposal. Gain on disposal. PP. You give your blank. Get the difference. 560 minus 440. 120. So that is 120. Get it out. Go to note 5. The following schedule relates to financial assets. So the financial assets, they started with 1620. Then what happened? Less carrying amount of financial asset than what? Disposed. They sold off a financial asset with a value of 235. So check, they sold it for how much? The sale proceed of financial asset was how much? 360. Profit on sale of is included. So now, atangoja kidogo, wait kidogo. The sale proceed of financial assets was 360. Profit on sale of financial assets is included in the investment was income. We are supposed to subtract, but I'm going to deal with it in the investment income because the investment income is going to be subtracted. It is not a normal business trade operating income. So so once you are done with depreciation, impairment, gain or loss on disposal of assets, go back to the P&L in the question. So in the P&L, I want you to check where we had PBT. The PBT which we had was showing how much? 1675. So can you check where we had this? You have seen it. So what I want us to do, I want us to climb up the ladder. We go backwards, checking for non-operating items. Operations are 4. Revenue, which we assume to be sales, admin, distribution, cost of sales. Anything apart from those 4, even if you don't know the wording, provided they added, subtract. Provided they subtracted, add back. That is how we rectify our operations. So let's start from down, climbing backwards. So climbing backwards, which one are you coming across? Finance cost. So finance cost, they are subtracted. What do? You add it back. Finance cost is this category of interest. Do we incur interest on daily operation? No. Next, climbing up, income, investment income. Investment income, that is not an operating income, to 70. Total. Climb up again. Operating profit, no, that is the total. Share of profit of associates. So associates profit, they are added 90 total. Climb up, admin, distribution, cost of sales, revenue. Perfect. I think only those. Once you have rectified the P&L, that should be everything. I don't see anything unless, is there a note which you feel we have not captured? We can shop across just to check, but I believe we have captured everything.
If we had additional information on this ones, we have to adjust first. Finance cost, investment.
Yeah, but which is very rare. Very rare. Very. The only note which we have not captured, check the note before note 2. Check. Na sasa hiyo itatupeleka working zingine mingi. Sawa, check the note before note 2. Though it will take our time. Kidogo si sana. The gain stroke loss on disposal of subsidiary is included in the administrative. Loss on sale or loss or gain on disposal of subsidiary. They'll say this again. Gain stroke loss on disposal, that is not an operating income. So, and we were not given. So we have to calculate it. So we want to calculate the gain stroke loss on disposal, then we subtract. It is not an operating income. So can you have a working? Have a working for? Gain disposal of subsidiary. So just from how we used to do consolidation, so check the proceeds. Proceeds on disposal. How much? Check from that note. They sold it at how much? 310. Yeah, it was sold for 310. Check unimpaired goodwill. Unimpaired goodwill disposed. I remember it will pay about 30, so it was 30. Check that working you did for goodwill. For the subsidiary disposed, we got 30. Then net assets disposed. Net assets disposed ngapi? So 300. Those items in note 1. check the total items in note 1 on the date of disposals. It is 300. Then NCI, you less NCI. Of these net assets, NCI were controlling 20% of the 300. So they were controlling how much? 60. There are two ways. You can work it two ways. You can take 80% of this, then you fail to capture NCI. Or you bring full, then you subtract. So now, yes. So 30 plus this minus 60. To 70. So these people gain. So there was again gain of how much? 40. So that gain of 40, they have included it as part of admin. Go and remove it there. It is not an operating income. So you come and say gain on disposal subsidiary 40 TOA. Can you give me now what you call cash flow before working capital changes? I'm not really for all right, so how much when you adjust? 2070. Call it cash flow before working capital changes. Cash flow before working capital changes. 2070. Let's go for working capital. As I write working capital, check your notes, the format, what you wrote under your working capital. So working capital, is you just check the increase or decrease in current what? Assets. Most importantly, these three: inventory, receivable, payables. By extension, you can have prepayments and accruals, but mostly those two. So can we go to our question? Let's go to our question. Tell me, inventory, start with inventory. Tell me whether it is an increase or decrease, and by how much. Check well. Online, someone tell me increase, decrease by how much? Bernard, you are getting? You just tell me the answer. I need a story. Isaiah says it's a decrease by 315. But Isaiah America in capital letters. Isaiah. Zero. The answer is two, I think 225. 315 is not correct. If you are getting 315 wherever you are doing it section 3 style. 225. What makes this cash flow to be advanced is that subsidiary. If you are not factoring in subsidiary, then it is not advanced cash flow. Booking all your subsidiary, then that thing is not advanced. So don't forget about subsidiary at any given point. So check. We started with inventory worth how much? 1710. We disposed. So take 1710 minus subsidiary went with inventory worth how much? 90. So 1710 minus 90. Then is when you compare. So it is a decrease. Decrease in inventory. How much? 1710 minus 90. Then it went down to 13. A decrease of 225. Decrease in stock you add. It means you are selling. Unauza. Using the same approach, now you can give me receivable and payables very fast. But for the time purposes, let's check very fast. Receivable, we started with how much? 1620. You know what decrease that at the bottom and the left. Decrease in receivables. We started with 1620. We disposed how much? 50. We closed with how much? 1125. A decrease of how much? Right? 445. 445. That one also you add. Decrease in receivables means una collect madeni. Next, payables. Payables, this is another year one decrease. So decrease in payables. So we started with the 2920. We disposed payables, that is 60. Some students wanakuja wanasema minus 60 because they were bracket. The minus was for them to get the net asset. They took asset minus liabilities. So usiseme hiyo minus, tunasema minus. Hapana. It's just the negativity here was to determine the net assets. So minus 60, then it went down to how much? 2115. A decrease of how much? That is a decrease of how much? 745. Confirm? But that's what you subtract. Decrease in payables means we kazi yako ni kulipa madeni. So question, can you adjust from cash flow before working capital changes? Adjust these three, then you get what is called cash generated from operations. Generated from operations. So can you adjust and give me the answer? 1995. You wind up by saying tax paid. Now you can pay tax. Tax paid. So tax paid, let's do a working for taxation. So taxation, right there, taxation. When you want to know the tax paid, this is what you do. You say tax liability at the start. So you say balance brought down. Balance brought down. Balance brought down, the liability, you check both deferred and current. So at the start of the year, how much was the deferred tax in the long term liabilities? 800 and what? 80. They are not paid deferred 880. Current tax was 1240. So how much was our liability, tax liability at the beginning? 2120. P&L, how much were we charged? Profit and loss account. Check for the year in the P&L. So this is for the year because company at the start does not mean during the year we will not charge. We find it will be comfortable to charge you another one. How much are we charged? In the P&L? Yeah, 415. Did subsidiary go with some tax? Check some. Anything you are doing, your mind should always be tuned to subsidiary. Kill us up, subsidiary. What, did subsidiary go with some tax? Yes. Deferred tax liability. Subsidiary left with tax worth how much? 20. Subtract. Give us what it should be. So those are the tax adjustments. We started with this obligation. For the year we were charged this, subsidiary left with 20. How much should it be? 2515. Skip one line. What is the balance carried down? If it comes to 2515, then it means there is no tax paid. It is still instant. What plus what? The liability. Check the liability at the end, other than current liabilities. Deferred is how much? 315. Current 440. Add the two. 755. It has decreased. That decrease means these people paid. They are just not telling us. So tax paid. Check the decrease. Decrease is how much? 1760. That is what they paid and they don't want to say. So go back to the cash flow. This is 1760. And operations ends there. Can you tell us how much is that? You get 235. Positive. Positive 235. Bring it here, call it A. Call it A. Good. Good. So we are done with the operations unless someone has a question. There being no question, let's go to investing. So investing, I want you to go to your notes. Check. So there are two things, notes and the format. So I want you to read the notes under investing, then the format. Then you check what goes under investing. Investing activities. So check those two, then we pick up. What goes under investing? Non-current what? Assets. So when you want to work investing in cash flow, go to non-current assets. And I'll tell you what you are looking for. So we are there. The first item you are seeing is which one? PPE. Ukiona PPE kwa cash flow, two things. During the year, how will PPE affect cash flow? Either you acquired more assets or you sold. So when you sell, cash in. When you acquire, cash out. So for PPE, bring those two things. Then we'll check for them. Cash received on what? Disposal. PPE. Cash paid to acquire. PPE. Those two. So for PPE, bring those two items. In every cash flow, whatever I can do you. So from experience, what examiner always do, of these two, they will give you one, then they deny you another one. So the one you are denied, you have to. There is no cash flow with PP account. So you prepare PP account, then you compare the movements. Meanwhile, which one were we given? Disposal, right? So check where PP was disposed. I saw it somewhere. Note 4. Check note 4. H disposed of a plant with a carrying amount of how much? For 44. Cash proceeds of how much? 560. So 560 is what we got. Cash received on disposal. We got 560. This other one, not even struggle to look for it. Definitely, where's the power? You have to do PP account. So have a reconciliation for PPE. You check the movement. You check the movement. Let's start with opening. Balance brought down. Balance brought down. What was the balance brought down for PPE? 41? 85. Let's go to the notes. From note 1 to the last, anything touching on PPE, you deal with it accordingly. 1, subsidiary left. Did they leave with some PPE? Yes, 12. Subsidiary left with PPE was how much? 210. So that one you subtract. Good. Note 2, nothing. Note 3, impairment, out. Note 4, they disposed. Disposal, there is plant which was disposed and it was having a carrying amount of how much? For 40. Less. That one you less. Number 5, ignore. Number 6, nothing. But there is one I always forget. Today I will not forget about it. Revaluation. I always forget about revaluation. So check revaluation and equity. Check revaluation and equity. It should be adjusted there. Revaluation and equity. Under equity, revaluation surplus. In bracket PP and financial assets. I only want for PPE. So revaluation will be 300 minus what? 200. So that's the revaluation surplus, the increase. But when we say kuna financial asset, your financial asset lazima tutoe. So can you go to financial assets? Note 5, check note 5. Financial asset was broken down well in note 5. Check additional information number 5. Are you seeing what they are saying? Add fair value gain on financial assets. Are you seeing it? 35, eh? So that was the revaluation of financial assets, that 35, financial assets. So your total. So this is 100 minus 35 is 65. So revaluation is 65. So how much should it be? How much? 86. 3,600. Hoping that nothing has been left out. Closing. Closing. Check the closing PPE. Carry down. Oh wait, depreciation of the job. So depreciation the punguze value. So less depreciation. Less depreciation. Depreciation was how much? 200 and what? 60. So the value should be how much? Minus 260. 33, 40. So compare with the closing. So check carry down. Carry down is how much? 42. So this increase. Give me that figure. How much did they acquire? 935. Yes, so Emma amesema hapo 935. Toa. You subtract, that is cash outflow. Go to the next item under non-current assets. Hautoki hapo. Goodwill tulimalizana kwa impairment, sio? Ignore. Go to the next. Intangible assets tulimalizana kwa impairment. Out. Financial, investment in associate. Investment in associate ukiona tu hivi. Andika hapo. Dividends. Dividends from associates. Dividends from associates. Dividends from associates. Yes. Dividends from associates. Dividends from associates. So dividends from associates. I want you to understand when you are associates are a small company. We invest and we wait for dividends. So if there is decrease in your investment without communication, we are seeing dividends. Some people will pay you dividends based on what you have invested. So how much was the investment in associate at the start of the year? It's 10, sure. How much profit did they give us for the year? Check P&L. Ile munasemanga post-acquisition profit. So this was the initial investment plus post-acquisition profit. Check P&L. Share of profits of associates. We were given how much? 90. So it means at the end of the year, we should be working telling people that our investment is now how much? 900. But examiners refused. You said your investment should be standing at how much? 720. That decrease of this 180. Yes, it's an income on your side. Your dividends, your investment cannot just decrease like that. Next item under non-current assets. Next item under non-current assets. Which one are you seeing? Financial assets. That financial asset venye iko ilikuwa 1620 ikaenda 1935. Tungesema acquisition direct. But sasa ile imekuwa broken down into pieces. Twende for your breakdown in note 5. Otherwise, the way it is, I would have assumed acquisition. But for the design, it was broken down beyond. So balance brought down that less carrying amount of financial asset than what? Disposed. How much did we get when we disposed that 235? 360. The same proceed of financial asset, 360. So that 235 was sold at 360. Better. Cash on sale of financial assets, we got clean 300 and what? 60. You add. Yes. Next, about to go financial assets, add purchases. Are you seeing purchases of financial assets? Toa, tulidumia pesa yetu. Cash paid to acquire financial assets. How much? 515. Out. And those are the two things I wanted. So, those are the two things I wanted about the financial assets. We can have acquisition or what? Disposal. So financial assets, bye-bye, tumalizana. So non-current assets, Non-current assets, we are done. Once you are done with the non-current assets and are investing, two things you need to check. One, investment income. Investment income will be subtracted under operations because it's not an operating income, but you add it in investing income. So let's go there. Though ilikuwa na shida to rectify. Let us investment income. Iko na shida. It was 270. I can't even remember. Check investment income in the P&L. $270, but there is a problem, which they say the note before note 6. The note before note 6. The sales proceeds of financial assets were 360. Profit on sale of the financial asset is included in investment what? Hiyo toa pesa, kuna pesa tulipata hapo. Tulisha rectify huko kwa operations. So minus that gain. The gain is what you received 360 minus the book value of that asset. The book value was 230 what? 5. So the gain, I'm removing that gain from investment income. You tulisha need now for operations inside that 270. Here you bring the clean investment income, not gains. Those gains we rectified in operations, that's the reality here. One, the gain. No, the everything. 145. That is a plus. Yes, please. Include those dividends. Because you know why it is okay. See your investment income yote tulitoa huko the 270. Now dividend should come under this side, which if they are included, this is okay because it should be here. Investment income here. What we don't want is the gain. So one more thing remaining. I said once you're done with the non-current assets, you check two things. One, investment income. Two, you check on subsidiary. Subsidiary is an investment. So you know subsidiary, that is your investment. Yenye ukifunga macho unaangalia investment, iko investment kwa this subsidiary, what, fine. So when you sell a subsidiary, the money you get when you sell that subsidiary should be here. It's an investment income. So you say net cash on disposal subsidiary. Net cash on disposal of subsidiary. So can you check subsidiary was sold for how much? Subsidiary was sold for how much? 310. So the only problem we normally have in every cash flow, we sold to them at 310. Na hebu angalia zile vitu zetu tuliwauzia hapo ndani, those things we sold. Tuliwauzia mpaka cash. Tunaona cash hapo ndani? Of how much? 30. So you sold to them at 310, na wewe pia uliwaachia cash huko ndani. So that's why I'm calling it what? Net. You subtract. Ndio. Umeniuzia nguo. Umenipea hiyo shati yako, kumbe ulikuwa umewacha umeniuzia 100 na uliacha 50 bob hapo ndani. After nimeshaenda majuu na koti yako ndio nakumbuka hiyo koti ilikuwa na 50 bob. So niuzia pesa ngapi? 100 minus your 50 which is gone. So if you get overdraft you add. Ukiwachia deni waende walipe. So you get overdraft you add. If it is cash available you do what? You subtract. How much? 2? 10. To what? 280. That is the net cash. Quisha, we are done. That is how you do investing. Can you add? Wait. Cash flow. No joke. How much do you get? Positive. Positive 75, call it B. Ili amesema 75 but amesema na taswishi. Can someone confirm? Can someone confirm the additions? Online nobody is talking. Ama muko 75 confirmed by so many people. Good. Let's go to financing. Maybe we can finish this thing. Financing, we want to finance now. Financing activities. What you do for me, go to your notes and format. Check those two things. You'll be able to see what goes under that. Check those two. What was that? It is all about the alteration of capital structure. So you go to equity and liabilities down there. Na hiyo ndio unafaa ujue. Ukiwa kwa working capital, current assets, current liabilities. Ukienda investing, non-current assets. When you go to financing, equity and liabilities. Kila kitu hapo lazima iangaliwe. So let's go to equity. Let's go to equity. Under equity, are you seeing ordinary share capital? Hiyo ukiona tu hiyo ordinary share capital, wewe andika tu hata kama itakuwa tutasema if any. Just write cash on issue of new shares. Where andikanga ipo? Cash on issue of new shares. I'll tell you how it comes across. Cash on issue of new shares. So what you do, you check the value of shares at the beginning of the year. You combine ordinary share capital plus the sister. You know the sister of ordinary? Share premium, eh? Was it there? Apparently it was not there. So you combine them at beginning, then you check the closing figure. If there is an increase in shares without communication, means those people issued. So they issued shares to the public. And they don't issue for stones. They issue for what? Cash. So like ordinary was how much at the start? 6. It went to 8. That increase, don't wait to be told that they gave out. We know. We as a Team Alliance, this is how much? 2,000. Increase in shares without communication is issue. Usianze kufikiria na labda accountant alikosea kidogo. Hiyo ni baadaye. Next, check next item. Under equity, revaluation surplus, always ignore in cash flow. It is only relevant when reconciling PPE. When you revalue your assets, there is no money you get. See, revaluation, you just call a valuer. You tell the valuer that this land I bought 6 years ago at 1 million. Can you now tell me, do your valuation and tell me how much? Then the valuer will come. They normally come at around 10 in the morning, you know, na gari ya white. Alafu anapack chini ya mti anakuambia saa hii ni 2 million. Alafu anakuandikia vitu anaandika, alafu anakuambia nipe pesa kidogo. Hata ni wewe unamlipa. So because you are to you pesa unamlipa, revaluation you only realize when you sell the asset. So there is nothing, ignore. Go to the next. Retained earnings. Retained earnings in cash flow will help you to get dividends which was paid to the parent company, the members of the parent company. That is how we utilize retained earnings. In the next question, I will not do that working, but this being the first, what to find you're working so that we can get dividends. Otherwise, it's something you can do here. In fact, I think dividends paid to full column parent, and you cannot pay parent na uache watoto, sio? They will bring problems. Kama saa hii wenye wako nyumbani labda wametoka mahali, unaweza beba machungwa umebebea mama amebebea mzee peke yake na hajabeba ya watoto, na mzee ako comfortable anakula, never. So when you pay the parents, make sure NCI are also paid. So andika hivyo, then we do working for parents, then we see how NCI will come up. So if you are outside working, you call it retained earnings. Retained earnings. Balance brought down. How much retained earnings were we having? You know, retained earnings ni kama ile reserve imekaa hapo. The profit imelala. So how much was the retained earnings? 31, 35, correct. Retained earnings was 31, 35. When we started the year, what about for the year? Check profit for the year. Was it comprehensive? You comprehensive, you can evaluation. So check profit for the year. So add profit for the year. Profit for the year. How much? 1260. Lakini kwa group accounting unajua vizuri, profit for the year they have to share with minority. So unagawa mara mbili. So check note number 6. Check note 6. What did they say? The profit for the year attributable to the noisemakers was how much? 390. So of this 1260, you are telling me minority took 390. So parent attributable to parent is the difference. So subtract what went to the minority. Profit for the year is in the P&L, just in case someone cannot be able to see. P&L, profit for the year. Don't bring comprehensive because comprehensive has a revaluation component, which does not involve cash inflow. So how much is this? 870. That is 870. So it means the profit should be this plus this at the end. So can you add those two? You will die. 40, 4005. Skip one line. Is that the profit being reported by the accountant at the end? No. How much is this at the end? 37.15. Decrease. Profit has gone down. Decrease in profit without any communication means those people paid what? Dividends. So that's the dividends they pay to members of the parent. They paid how much? To 90. Kuja utoa hapa to 90. That is how you get dividends to the parent. Very easy. Brought down, during, compare. Here imekuwa ngumu because you had to subtract this. In some questions, wanakuambia direct. Kwa P&L, profit attributable to the parent. Direct. So you just take this plus this minus the closing. I go to the next item under equity. Go to the next item under equity. Next item, equity attributable to non-controlling what? Interest. They will give you problems. Adiwawesikia pale walilipwa jana. Wanaanza kuongea vibaya. Sisi tunajua we don't have a say, but God in heaven is watching. So let's calculate for them their dividends before they bring problems. So check the balance of minority at the beginning of the year. Mtu asijiulize na equity attributable to owners of the group, that is the total of those which are appearing above. So minority at the beginning, how much can you be able to capture? My eyes can capture 585. 585. For the year, it's nearly 390. So for the year, 390. Then tunataka kuwakazia kama si kuna subsidiary tulikuwa na 80% na inauzwa. What is their net assets? Sahi wakiuzwa, we sell them right now. What is the net assets of that subsidiary? It's 300. Minority walikuwa na control 20%. Hiyo wana dispose. So subsidiary disposed. They have a net asset of 300 multiplied by 20. What I suffer 60 total. Give us the expected balance at the end. If you master this thing, customer will know who you are. Wow. Next. All right, so expected is how much? This plus this minus this? 915. According to Mr. Examiner, 810. That decrease of the leap one. They have been paid how much? Huh? 105. So they should keep quiet. Lakini watu watateta. Ulisikia walikuwa to 90. Alright, that is how you calculate it. It's very simple. Next item are equity and liabilities until you exhaust them. Kuna long-term borrowing. Eh? How much was the long-term borrowing when we started Prudent? Why don't we include the disposal of the retained earnings of the parent? Disposal of the retained earnings, which one? Which one was disposed? The net assets. Ama gani? Prudence, be clear there as we proceed and check. Long term, beginning 610. Sindio? Closing, hakuna kitu ingine kwa long term. Closing wakafunga na ngapi? To 35. Hao watu wamelipa. Sindio? Decrease in loan. So repayment of long term borrowing, that decrease 610 minus 235, decrease of how much? 275. They are paid 375. Prudence, yes. The net assets of the subsidiary. So I'll tell you how. I'll tell you why and how. So Prudence, when we're calculating goodwill of the subsidiary disposed, utaona net assets tulichukua hapo 300. Just check goodwill, then we subtracted NCI. Wakaweka kando. So parent had already accounted for theirs during goodwill, not goodwill per se. When we were checking for gain on disposal, those net assets tuliweka hapo. The 300 tukatoa ya NCI 60, if you can remember that 60. So tulikuwa 60, the same 60 ndio tumeweka hapo. I hope you understand. Kwisha, tumemaliza, hakuna kitu kingine. Deferred tax tulimalizana, payable current tax kwisha. So how much is this? Understood, good. So how much is this? We are done with financing. Financing is all about, oh no, we are not done. Financing is all about equity and liabilities. Then once you are done, unaona finance cost. Finance cost, we added it in the operations because it is not an operating expense. You need to subtract it under what? Financing. So finance cost, it was how much? 100. Sorry for that. It was 100. It was 100. $13, $13.30 positive. 11.30 positive. Positive 11.30, call it C. Sasa msema ukweli inakuja. Unajua cash flow inakuwa na answer yake. So say here net changes. Net changes in what? In cash flow. So net changes, you take A plus B plus C. So can you add for me the three? A plus B plus C. A plus B plus C. Hivyo tu ndio ulifikia watu hivi. It's good. It's very nice. So how much when you add the three? You add 235 plus 75 plus 1130. 14. 14, 40. You come here and say cash and cash equivalents. Cash and cash equivalents brought down. How much? Check current assets. Check your current assets. How much is the cash and cash equivalents in 2020? Menak? 27.45. So that we get cash and cash equivalents carried down. So if we are accurate, this plus this should give you what is appearing there as carried down. So how much is this? I hope it again actually like 85. Because how? In a reconcile now? 41.85. Accurate. So now in exam, we ukifanya hiyo A plus B plus C unapata 0. So there's no way 0 plus this one can give you this one. Make sure umemaliza na hii, umeweka hii, na ukajifanya mkora ukasema hapa x plus 27.45 will give you 41.81. Find the value of x 1440. Akipange hapo ndani, we'll talk about it so that you secure those things. So that is how cash flow is done. It is very difficult. If you reverse that one 3 times, so I'm not giving you assignment. That is the assignment. Go through it. The next class we will be meeting. I will check a question, which I believe is last setting part 1. We check a question for acquisition. This was disposal. So we'll check acquisition. Then our lives will be very good. My target is to do 3 questions in cash flow. That is 1. We shall overcome by all means. So tomorrow you are meeting a FM teacher at what time? 7. Oh, ile yake ni Monday. Oh. So hebu soma hiyo kitu. What was our program? Tomorrow is 8:30. Tomorrow is normal. Oh. Sawa. So tomorrow we meet at normal 8:30. Sawa. Tomorrow is 8:30. Sawa. Sawa. Kuna watu wame confuse mahali. Sawa, 8:30.